Imagine for a second that your entire business, your whole livelihood, relies on selling one highly specific piece of hardware.
Right.
And you sell it to exactly one industry. You build your factories around it, you hire all your engineers for this specific thing, and your whole revenue model basically assumes that this one sector is just going to grow to the moon.
Which is a terrifying position to be in, honestly.
It really is. Because then suddenly that industry hits a total brick wall. Demand softens, the supply chains get completely snarled, and all those euphoric growth projections just evaporate overnight.
Yeah, and for most companies, that scenario is basically a death sentence. I mean, you either go bankrupt or you get bought out for pennies on the dollar by private equity.
Exactly. But 2 years ago, Aehr Test Systems, ticker symbol AEHR, was staring down that exact barrel. I mean, over 95% of their revenue was tied exclusively to the electric vehicle market.
Just massive exposure to one single narrative.
Right. And today, that EV revenue is virtually gone. Yet if you look at their recent report, their product bookings just exploded by over 500%.
It's wild. They didn't just survive an industry collapse. They pulled off what is probably one of the most aggressive, most lucrative strategic pivots in modern hardware history.
They really did. So welcome to the Deep Dive.
We are looking at a company that fundamentally re-engineered its entire trajectory while the airplane was, literally in flight.
And that is exactly what we are going to dissect today. For those of you joining us, this is a special Talk Tickers edition of the Deep Dive. The mission here is super straightforward. You are a retail investor. You're out there scanning the headlines, watching the tickers flash red and green, and you're just trying to cut through an absolute mountain of Wall Street jargon.
Yeah, there is so much noise out there.
So much noise. You're trying to figure out what is actually happening on the factory floor. Right. You want an edge in the market. Yeah. Well, today we are handing you that edge. We are taking Aehr Test Systems. We are taking their Q4 2026 earnings call transcript, and we are just putting it straight under the microscope.
We're stripping out all the corporate fluff. The mandate for this deep dive is to be data forward, to speak in plain language, and to actually, take a firm position. We aren't going to just read you a balance sheet like some audio textbook.
Nobody wants that. Right.
We're going to look at the exact numbers management reported, but more importantly, we're going to unpack the mechanics of why those numbers exist. We'll evaluate the massive promises management is making for the next year and land on a definitive, actionable bottom line for your portfolio.
Okay, let's unpack this. We have to start with the raw data to establish a baseline. Before we can even talk about 500% booking explosions or massive strategic pivots, we need to know if the foundation of this company is built on concrete or quicksand.
Yeah, you have to look at the top line first.
Exactly. So let's look at those top line numbers for Q4. Revenue came in at $18.8 million. That is a 34% increase from the $14.1 million they posted in the exact same quarter a year ago.
Which, that's a remarkably solid top-line beat, especially when you consider the broader macroeconomic context in the semiconductor equipment space right now. There's been a ton of volatility.
It is a great beat, and it translates directly down the income statement, too. Their non-GAAP earnings per share, their EPS, came in at a solid 11 cents per share.
Which is a huge turnaround.
It really is. For the listener trying to track the momentum here, this completely flips the script from where they were a year ago. In the same quarter last year, they actually posted a 1 cent per share loss.
Yeah, we need to pause on that non-GAAP EPS figure for a second because it's a term Wall Street throws around constantly, and it can be really misleading if you don't know what it actually means.
Right. GAAP versus non-GAAP. Let's translate that.
So, GAAP stands for Generally Accepted Accounting Principles. It's the standard, super rigid rulebook for corporate accounting. When a company reports non-GAAP earnings, they're essentially saying, hey, here is our profit, but we are excluding certain irregular or non-cash expenses that we don't think reflect our actual day-to-day operations.
Like what, exactly?
Usually that means they are stripping out things like stock-based compensation for their executives and employees, or maybe a one-time restructuring fee.
Got it. So it's basically the real-world cash-generating power of the business, at least according to management's view.
Exactly. And flipping from a loss to an 11-cent profit is a massive psychological milestone for the market. It proves the business model is working.
But, the number that really caught my eye, the metric that usually reveals how efficiently a company is actually running its factory, is the gross margin.
Oh, yeah. The margin jump was incredible.
It was staggering. Non-GAAP gross margin jumped 10 full percentage points. They went from 35% in the prior year quarter straight up to 45% today.
I mean, 10 percentage points in hardware manufacturing is an absolute chasm. It's unheard of. In a software company, sure, margins fluctuate easily because the cost to, copy and paste code is basically zero.
Right, software is cheap to scale.
But Aehr is bending metal. They are building massive, highly complex physical testing machines. To squeeze another 10% of profit out of every single machine you sell requires a fundamental shift in how you operate.
And the chief financial officer, Chris C., he attributed this 45% margin directly to two things. He cited higher manufacturing utilization and a better product mix.
Let's translate that for the listener, too.
Yeah, let's break it down. Higher manufacturing utilization simply means their factories aren't just sitting there idle. If you have a factory that costs you $1 million a month just to keep the lights on, and you only build one machine, that one machine absorbs $1 million in overhead.
Right, which destroys your margin on that machine.
Exactly. But if you build 10 machines, they only absorb $100,000 each. Your margins instantly go up. But the second part, that better product mix, that is where the story actually starts to get really interesting.
It means they sold more of their highly profitable systems and fewer of the legacy low-profit systems.
Basically upgrading their sales catalog.
Essentially, yes. In Q4 of the previous year, their sales were heavily weighted toward older, package-level burn-in systems. Those systems are basically commodities at this point in the semiconductor industry. The margins are razor-thin because, frankly, everyone makes them.
So what do they sell this year instead?
This year, they shifted that mix heavily toward their advanced proprietary systems.
Yeah.
These are machines that command premium pricing because literally nobody else can do exactly what they do.
Okay, so the 34% revenue growth, the EPS flip to profitability, the 45% gross margin. I mean, these are the numbers that keep the lights on. They're great.
But they aren't the numbers that broke the matrix on this earnings call.
Exactly. You have a 34% increase in revenue sitting there. It's good. But it doesn't explain the kind of institutional buying frenzy we saw around this stock right after the call.
Not at all.
To understand that, we have to look at the forward-looking metrics, the real jaw-droppers, the numbers that represent the actual tsunami of cash rolling toward this company right now. Let's talk about the bookings and the backlog.
What's fascinating here is that this is where the transcript goes from just a standard earnings report to a major industry event. Q4 bookings exploded by over 500% to $60.7 million.
Just to contextualize that for the listener, a year ago they booked $11.1 million this quarter. $60.7 million, a 500% spike. That is just ridiculous.
And that booking explosion feeds directly into the second jaw dropper, which is their effective backlog. Going into mid-July 2026, Aehr's effective backlog is sitting at a record $100.6 million.
Over $100 million.
Yeah. To be precise, that is an $80.6 million year-end backlog, plus an additional $20 million in brand new bookings they secured during just a 4-week transition period right after their fiscal year closed.
Let's break down that term, effective backlog, because Wall Street loves to use vague language to make sales pipelines sound a lot more robust than they actually are.
I really do.
You'll hear executives throw around phrases like projected interest or pipeline visibility or memorandums of understanding. That is all fluff. It's maybe money. A customer saying, hey, we might buy this next year is not a business model.
No, but effective backlog is not fluff. It is the exact opposite of fluff.
Right. So what does it actually mean?
Effective backlog represents legally binding purchase orders. These are signed contracts from major semiconductor manufacturers who have essentially placed their money in escrow. The cash is committed.
It's locked in.
Exactly. The only thing standing between Aehr and recognizing that $100.6 million as pure revenue on their income statement is just the time it takes them to actually build the physical machines, load them onto a shipping container, and deliver them to the customer.
Over $100 million in locked-in demand. That is huge. But a number that large, a 500% spike in bookings, it doesn't happen in a vacuum.
Oh, definitely not.
It certainly doesn't happen organically just because you have like a really good sales team making cold calls. It requires a massive structural catalyst in the broader market. And to understand where that $60 million in fresh bookings came from, we have to look back at the company's existential crisis.
We have to look at the trap they were in.
Right. We have to look at what Aehr was doing 2 years ago and the absolutely incredible pivot they pulled off to survive it.
Which brings us to the silicon carbide trap. To understand the magnitude of this pivot, you really have to understand the technology they were married to. Like you said earlier, 2 years ago, over 95% of Aehr's revenue was generated by selling testing systems to the electric vehicle market.
95%.
Yeah. And specifically, they were testing chips made of a highly specialized material called silicon carbide.
Let's unpack silicon carbide for a moment. Why was this material so important to the EV market? And why was Aehr so heavily invested in testing it?
So silicon carbide is what's known as a wide bandgap semiconductor material. In plain English, traditional silicon chips, like the ones in your laptop or your phone, they melt or short circuit when you pump too much raw heat or electricity through them. They're fragile.
Right. They can't handle high voltage.
Exactly. But an electric vehicle isn't a laptop. An EV battery is dumping hundreds of volts of raw, massive power into the engine's inverter just to physically move a 3-ton truck down the highway. Traditional silicon just can't handle that kind of abuse.
But silicon carbide can.
It can. It handles massive voltages, it survives extreme heat, and it is incredibly efficient, which is crucial because that efficiency extends the overall driving range of the EV.
So 2 years ago, the logic was perfectly sound. Every major automaker in the world was pivoting to EVs. Every single EV needs these heavy-duty silicon carbide chips to manage the battery power, and every single one of those chips needs to be ruthlessly tested before it gets put into a $60,000 car.
It makes total sense on paper.
Right. Aehr basically positioned themselves as the ultimate toll booth for the EV revolution. They made the machines that tested the silicon carbide.
The logic was perfect until the macroeconomic environment abruptly shifted. Over the last 2 years, the EV market slammed into a brick wall.
It really did.
Interest rates spiked, making car loans suddenly unaffordable for the average consumer. Range anxiety persisted because the charging infrastructure just didn't build out nearly as fast as everyone predicted.
Did people stop buying them?
Exactly. Automakers suddenly found themselves with massive inventory just sitting on dealership lots gathering dust, so they slammed the brakes on new production.
And obviously, when automakers stopped building cars, the semiconductor foundries stopped buying the extremely expensive equipment needed to test the chips that go into those cars.
Yep, the domino effect.
If Aehr had stayed stubbornly loyal to that 95% revenue stream, if they had just, tightened their belts and waited for the EV market to eventually recover, this earnings call would have been a complete bloodbath.
Oh, without a doubt. We would be sitting here talking about mass layoffs and restructuring, not 500% booking spikes.
But they didn't wait. Management looked at the horizon, realized the EV wave was crashing on the beach, and they saw an even bigger wave forming out in the deep water. Today, that 95% reliance on silicon carbide has shrunk to under 5% of their fiscal 2026 revenue.
That is just staggering. To replace 90% of your revenue in 2 years requires capturing an entirely new customer base.
It does. And what replaced that EV revenue is the overarching theme of this entire earnings call.
Yeah.
Today, 71% of Aehr's revenue is driven by artificial intelligence and data centers.
Talk about a massive pivot.
Huge. And another 20% is driven by a highly specialized networking technology called silicon photonics, which we will explain in a moment because it's also deeply tied to data centers. Combined, over 90% of their entire business is now dedicated to powering the physical infrastructure of the AI boom.
They caught the AI wave perfectly.
They did. But I want to push on this because it sounds almost too easy when you just summarize it like that. Oh, they just pivoted to AI. You can't just take a machine designed to test an electric vehicle part, swap a cable, and plug an NVIDIA AI processor into it.
No, these are vastly different, incredibly complex technologies.
Right. So how are they actually winning these massive AI contracts? What is the underlying technology they're actually selling to these hyperscalers?
The foundational technology, the actual IP that Aehr holds the patents on, is called wafer-level burn-in, or WLBI for short. They also sell the proprietary contactors that make the whole system work, which they call WaferPaks.
WLBI and WaferPaks.
Yeah. And you are right, the technology sounds incredibly dry and boring until you actually understand the economics of how semiconductor manufacturing works in the real world.
Because testing systems sounds like they're just, plugging a chip into a wall to see if a little green light turns on. It is so much more violent than that.
It's intense.
I've been trying to visualize this process for the listener to explain why wafer-level testing is disrupting the whole industry. So imagine you are a major automaker, but you operate at the micro scale. You're manufacturing 1,000 highly complex, incredibly expensive luxury car engines.
Okay, I'm with you.
But you don't build them one by one on an assembly line. Your factory fabricates all of it, 1,000 engines simultaneously, completely interconnected on a single, massive, uncut block of solid metal.
Right, and in the real world, that block of metal is the semiconductor wafer. If you've ever seen one, it looks like a giant iridescent CD-ROM, and it contains hundreds or even thousands of individual uncut chips.
Exactly. Now, the old way of testing these chips, what the industry calls package-level testing, is borderline insane when you apply it to our car engine analogy.
It really isn't efficient.
So the old way dictates that you take a diamond saw, you chop up that massive metal block, and you separate all 1,000 engines. Then you spend massive amounts of money installing every single one of those unchecked engines into 1,000 fully finished, fully painted, leather interior luxury cars.
Which takes a lot of time and money.
Right. That is the packaging phase. And then, only after the luxury car is completely finished, do you turn the key in the ignition to see which engines actually work and which ones immediately explode.
And the brutal reality of semiconductor manufacturing is that some of them will explode. It is a statistical certainty. It's an industry term called infantile mortality in silicon.
Infantile mortality.
Yeah.
That sounds grim.
It is. Microscopic defects in the manufacturing process basically mean that a certain percentage of chips will fail within the first few hours of heavy usage. You can't avoid it.
But in the package-level testing model, if an engine fails at that final step, you don't just lose the engine. You have to throw away the entire finished luxury car.
You throw away the car, the leather interior, the custom paint job, all of it into the dumpster. And in the real world, the luxury car is the highly advanced, incredibly expensive packaging that surrounds modern AI chips.
And this is exactly what Aehr is solving. Aehr's technology, wafer-level burn-in, flips that entire timeline. Aehr builds a giant, highly advanced thermal and electrical diagnostic machine called the FOX system.
Right.
Instead of chopping with the block first, you take that massive uncut wafer containing all 1,000 engines and you plug the entire solid block into Aehr's machine. The machine forces electricity into all 1,000 engines simultaneously. It reds them to the red line, it cranks the heat up to blistering temperatures, and it aggressively stresses them to the absolute breaking point.
And this is what they call the burn-in phase. They are intentionally torturing the silicon. They are forcing those microscopic defects to reveal themselves early in a highly controlled factory environment, rather than letting a weak chip slip through and fail 6 months later while it's, running a critical data center server.
Precisely. So Aehr's machine tests all 1,000 engines at the wafer stage before they are ever separated. When you finally take the diamond saw and cut the block up, you have a perfect map. You know exactly which engines are flawless and which are duds.
You just throw the duds in the trash.
Exactly. And you only spend the money to package the perfect engines. For modern AI infrastructure, this isn't just a convenience. It is a financial imperative.
The financial imperative really comes from a concept called heterogeneous integration. In the old days, a computer chip was literally just one single chip inside a plastic box. Today, an AI processor, like a massive GPU used for training large language models, is not packaged alone.
It's way more complicated now.
It's incredibly complex. It is packaged alongside massive, hyper-expensive arrays of memory chips. They are all literally glued together on a single silicon substrate so they can communicate faster.
So if you use the old method, if you wait until after everything is glued together to run the stress test, and just one single component fails,
you lose the entire package. If a $50 logic chip fails during package-level burn-in, you don't just throw away the $50 chip. You are throwing away thousands of dollars worth of perfectly good attached memory chips that are trapped in that exact same package.
That's just burning cash.
It is. Aehr's wafer-level burn-in isolates the failure at the absolute earliest, cheapest point in the entire manufacturing lifecycle. It saves these semiconductor giants staggering amounts of money and preserves their production yield.
And it isn't just standard AI compute chips. We also mentioned silicon photonics earlier, which makes up 20% of the revenue. Explain how light factors into this whole equation.
So data centers have a massive bottleneck right now, and it's copper wire. When thousands of AI servers need to talk to each other to train a model, they traditionally send electrical signals over copper networking cables.
Right.
But at the speeds AI requires today, pushing electricity through copper generates massive amounts of heat and consumes enormous power. The solution to that is silicon photonics. Instead of copper wires, they use fiber optic cables. They integrate microscopic lasers directly onto the silicon chips to transmit data using pulses of light instead of electricity.
Moving data literally at the speed of light.
Literally. But here's the catch. Microscopic lasers are incredibly sensitive to temperature and manufacturing defects. You have to burn them in rigorously to ensure the laser doesn't degrade over time. Aehr systems are uniquely capable of handling the high-power, highly stabilized thermal environments required to test hundreds of these photonics wafers simultaneously.
Okay, the underlying mechanics make total sense. We know why the technology is necessary. But the ultimate proof of concept is whether the biggest players in the industry actually agree with this thesis and are willing to write the checks.
And they are.
They absolutely are. And CEO Gayn Erickson shared a story on this earnings call that confirms this isn't just theoretical. We'll call it the benchmark win.
It was, without a doubt, the most significant flex on the entire earnings call. Erickson detailed how they recently completed a grueling benchmark testing phase with a top-tier, multi-billion-dollar supplier of AI accelerators and CPUs.
This wasn't just a casual demo in a lab.
No, this customer took their actual highly complex AI processors and ran them through Aehr's wafer-level systems to see if the yield savings were actually real.
And what were the results?
The results literally exceeded the customer's own internal expectations. Erickson stated that, in the customer's own words, the wafer-level system produced defect screening results that were fundamentally better and more comprehensive than the data they were getting from their traditional legacy package-level testing.
And what was the immediate actionable result of that benchmark data? Did the customer just, put a gold star on the report and say, hey, we'll keep you in mind for next year?
Far from it. Originally, this benchmark was designed just to evaluate Aehr's technology for a future next-generation device timeline. It was essentially an R&D exercise.
Right.
But the data was so compelling and the potential cost savings were so massive that this top-tier supplier immediately told Aehr they want to pull the entire timeline forward.
Wow.
They are moving to pilot production test validation for their current high-volume device right now out at their contract manufacturing hub in Taiwan. They didn't even stop there. They asked Aehr to evaluate a second, completely distinct AI device in parallel.
That is the ultimate definition of a sticky product. When a hyperscale customer tests your equipment for a future roadmap and realizes the technology is so superior that they literally need to halt their current operations and retrofit a multi-billion-dollar active production line to integrate it today.
It's the dream scenario for a vendor.
It really is.
Yeah.
And the momentum isn't isolated to just this one new benchmark. Their lead AI processor customer, a company they've been working with quietly for a while, is also drastically expanding their footprint.
Yeah, Erickson noted that this lead AI production customer is shifting all of their production burn-in screening to wafer level on Aehr systems.
All of it.
100%. This is the holy grail for a testing company. The customer is completely eliminating their system-level screening protocols. They no longer feel the need to perform back-end stress tests because Aehr's FOX systems and those proprietary WaferPak contactors are catching the defects so flawlessly at the wafer stage that the back-end testing just became entirely redundant.
Which brings us to the next massive pivot in our analysis. We have the raw Q4 numbers. We deeply understand the pivot from EVs to AI. We know exactly how the underlying wafer-level technology saves these companies millions, and we have top-tier customers knocking down the door.
We have the whole narrative.
We do, but as a retail investor, you are not buying the past. The market doesn't actually care what you did yesterday. The market only prices in the future. You want to know exactly what management is promising to deliver for you in the coming year.
And this is where the transcript elevates from a solid, reassuring earnings report into a fundamentally disruptive guidance model.
Here's where it gets really interesting. Let's look at what I call the monster guide. Management is projecting their fiscal 2027 revenue to come in between $130 million and $150 million.
We really need to pause and let the gravity of that number sink in. H-Share just reported $50 million in revenue for the entire full fiscal 2026.
$50 million.
By guiding for $130 million to $150 million, management is publicly projecting a jaw-dropping 160% to 200% year-over-year growth rate.
200% growth in a single fiscal year.
And crucially, they are not buying that revenue with unsustainable losses. They aren't slashing their prices just to move volume out the door. They are targeting an 18% to 22% non-GAAP pre-tax net income margin at those massive revenue levels.
So they're going to be highly profitable.
They expect to be wildly profitable while they literally triple the size of the company.
Okay, I am putting my retail investor hat on right now, and I am throwing a flag on the play. I have to push back here because 200% growth sounds absolutely amazing in a press release, but the operational reality of physically building that much hardware is a nightmare.
Yeah, it's definitely not easy.
And I am using the CEO's own words against him here. Gayn Erickson explicitly warned on this very call that the semiconductor testing business is, and I quote, lumpy. He openly admitted it can be highly cyclical.
He did. He was remarkably transparent about it. He told the analysts, one of the challenges in our business is that it is always going to be lumpy.
Right. So if the business is inherently lumpy, if demand comes in these massive, unpredictable waves, and they're suddenly staring down the barrel of $150 million in immediate demand, how do they actually fulfill it?
That's the big question.
Because to triple your output in hardware, you usually have to spend hundreds of millions of dollars building massive new fabrication facilities. You have to buy prime real estate in California. You have to pour concrete. You have to build clean rooms. And if they build all that massive permanent infrastructure to hit this year's guide, won't they just bleed cash and go bankrupt when the AI cycle eventually turns and demand softens? This just seems like an incredibly risky bet for a small company.
It is the single most perceptive pushback you can have, and it is exactly the risk profile that an institutional analyst named Larry Klabina drilled into during the Q&A portion of the call.
Smart analyst.
Very. The fear of overexpansion is what kills most hardware companies. But this is where Aehr's operational strategy reveals itself to be actually quite brilliant. They have deliberately engineered what they call a capital-light operational model.
Capital-light hardware. That sounds like an oxymoron. Explain to me how you triple your manufacturing output of industrial machinery while staying capital light.
We have to look at the cash flows. Let's look at their capital expenditures, their CapEx, for the entire fiscal 2026. CapEx is the money a company spends on buying, maintaining, or improving physical assets like buildings and heavy equipment. Their CapEx for the entire year was only $2.1 million.
Wait, $2.1 million? That's nothing.
Exactly.
That buys you maybe a nice office building renovation in Silicon Valley? It certainly doesn't build a massive semiconductor equipment factory.
It is incredibly low for a company in the sector. So how are they doing it? How are they fulfilling $150 million in complex machine orders? Instead of building permanent, inflexible infrastructure in California, they are outsourcing all the heavy lifting.
Outsourcing.
They have forged a strategic partnership with a massive contract manufacturer based in Southeast Asia. And this facility isn't just some generic warehouse. It has been highly upgraded to near clean room specifications. This single outsourced facility is capable of pumping out 20 of Aehr's advanced Sonoma systems every single month.
Wow. So they just completely bypass the capital risk of real estate and facility management. They let the contract manufacturer take on the burden of owning the building, and Aehr just pays for the assembly as they need it.
Exactly. And the physical design of the machines themselves really contributes to this efficiency. Erickson made a fantastic spatial analogy during the Q&A to explain their competitive moat.
Let's hear it.
He compared the physical footprint of Aehr's FOX systems to a legacy competitor system. He specifically called out an Advantest machine. He told the analysts that you could fit 20 of Aehr's multi-wafer systems in the physical space of about 20 standard parking stalls out in a garage.
Okay, so it's very compact.
Very. But to get the exact same equivalent testing capacity, to test the same number of chips per hour using their competitors' legacy equipment, you would need 180 massive machines. You would need 180 parking stalls worth of space. And not just out in a garage, but inside a highly expensive, bunny-suited, hyper-filtered clean room floor.
That physical footprint advantage is a massive selling point.
Right.
Real estate inside a semiconductor fab is some of the most expensive square footage on planet Earth. If Aehr can give a customer the same exact throughput in 10% of the physical space, that is a massive reduction in the customer's overhead costs.
It's a dual advantage. It saves the customer floor space, and it allows Aehr's contract manufacturers to assemble the units much more efficiently because they don't take up city blocks of warehouse space in Asia.
Hold on, though. I am going to push back harder here. Outsourcing the factory floor solves the real estate problem, sure. But Aehr is still building $150 million worth of highly complex custom testing machines. Contract manufacturer or not, you still have to buy the raw materials, right?
You do.
You have to buy the microprocessors, the steel, the hyper-specialized power supplies, the proprietary WaferPak contactors. That requires a massive amount of upfront cash just to buy the inventory.
It takes a lot of working capital.
Right. And if an AI hyperscaler suddenly realizes they overbought GPUs and they unexpectedly cancel a massive order, Aehr is still left holding tens of millions of dollars in highly customized, totally unusable inventory. contract manufacturer or not, how do they mitigate the sheer inventory risk of tripling production overnight?
You are hitting on the fundamental working capital risk of rapid scaling. And management saw this exact bottleneck coming a mile away.
Oh, they did?
Yes. This is where their financial maneuvering from the past year pays off spectacularly. They knew they needed a massive war chest to float this production without taking on toxic debt. So during fiscal 2026, while their stock price was performing well, they utilized an at-the-market, or ATM, equity offering to raise approximately $100 million in pure cash.
Let's define an ATM offering for the listener, because it's really different from a standard secondary stock offering.
Yeah, it's a very different mechanism.
A traditional secondary offering is a massive, highly publicized event where a company dumps millions of new shares on the market all at once. And that usually tanks the stock price immediately because it dilutes the existing shareholders so violently.
Exactly. But an at-the-market offering is much more surgical. An ATM allows the company to slowly, quietly trickle newly created shares into the open market over a period of time at whatever the prevailing market price is.
Ah, I see.
They sell a little bit here, a little bit there, whenever there is enough buying volume to absorb it without crashing the stock. It is a highly efficient way to raise capital if your stock has strong daily liquidity.
So they just trickled out shares, raised $100 million, and completely bolstered their balance sheet.
They drastically fortified it. Thanks to that ATM, they ended the fiscal year with $116.5 million in cash and cash equivalents. Contrast that with just $26.5 million the year before. They now have an absolute war chest of flexible working capital.
Okay, that changes the math significantly.
It changes everything. They can use that $100 million to preemptively buy the long lead time components, pay the contract manufacturers in Southeast Asia, and float all the inventory costs required to fulfill these massive $150 million orders. And they can do it all without taking on a single dime of crushing high-interest bank debt.
And what about that cancellation risk I brought up?
Regarding the cancellation risk, these effective backlog orders are strictly locked in. And honestly, the AI infrastructure build-out is moving so fast right now that customers are begging to pull timelines forward, not cancel them.
So they have the demand locked in the backlog. They have the outsourced manufacturing capacity in Asia to physically build it.
Yeah.
And they have the $100 million cash buffer to fund the entire operation smoothly.
Yep. As Erickson said, they don't want to build up a massive fixed infrastructure that just bleeds money in a softer year 5 to 8 years from now. They are scaling up virtually.
It is textbook agile hardware manufacturing. Which brings us to the final act of this analysis. We've examined the 500% booking spike. We understand the technological superiority of wafer-level burn-in and this massive AI pivot. We vetted the $150 million guidance and their capital-light defense. Now it is time to distill all of this raw data into a definitive, actionable thesis. What does this actually mean for your portfolio?
But before we hand down a final verdict, a smart investor never just buys the hype. We have to look at the bear case. This raises an important question. What could break this model? What are the immediate risks lurking in this transcript that could derail that 200% growth?
Let's lay them out. I see 3 distinct operational risks that management was essentially forced to address on this call. Risk number 1, the supply chain squeeze.
Erickson was remarkably blunt about this on the call. He explicitly noted that some of the highly specialized power supply manufacturers that Aehr relies on to build their high-voltage Sonoma systems are the exact same suppliers that NVIDIA uses for their massive AI servers.
Oh, wow. If you are a small semiconductor testing company and you suddenly find yourself competing with a $3 trillion behemoth like NVIDIA for the exact same raw materials, you are going to lose that bidding war every single time.
Every time.
Or you are going to pay an absolute astronomical premium to jump the line.
And they are paying the premium. Why does NVIDIA affect Aehr's power supplies? Because these new AI chips draw so much raw power, the testing machines require ultra-specialized high-density voltage regulators just to safely push that electricity into the wafer. It is a finite global supply of these specific components.
And so what did the suppliers do?
Erickson stated that those suppliers have come back to Aehr and aggressively raised their prices by 40%.
A 40% markup on critical components. That is a massive hit to the cost of goods sold.
It is intense supply chain cost pressure. And it doesn't just cost more money, it actually costs time. These components come with severely extended lead times. Aehr's management is going to have to execute flawlessly to absorb that 40% component hike while still maintaining that 45% gross margin they're so proud of.
Got it. 40% markup on power supplies is a very real headwind. What is risk number 2?
Legal battles and intellectual property theft. Chief Financial Officer Chris C. brought up ongoing patent litigation in China. Aehr is currently locked in a nasty legal battle against a company called Semi-Nexus Test.
Lawsuits in foreign jurisdictions, especially involving Chinese intellectual property courts, are essentially just a black hole for legal fees. The cost of just maintaining local counsel can drag down quarterly earnings for years.
And that is exactly what happened here. The legal fees associated with this Semi-Nexus suit were a notable drag on the Q4 earnings. C warned the analysts that they anticipate incurring additional ongoing legal expenses in the upcoming quarters as this whole thing just grinds through the system.
What are they actually arguing about?
Aehr alleges that this company, which, by the way, recently reincorporated in Malaysia to seemingly avoid jurisdiction, is blatantly violating Aehr's core intellectual property regarding silicon carbide wafer-level burn-in systems.
But is there any light at the end of the tunnel on this lawsuit, or is it just a perpetual drain on their cash?
There were 2 major silver linings reported on the call regarding this. First, the patent office in Beijing just officially upheld 2 of Aehr's critical Chinese patents, which management considers the absolute cornerstone of their legal case. It validates their IP in the jurisdiction.
That's a huge win. And the second?
Second, and perhaps more importantly, the free market is speaking louder than the courts. Aehr just announced they won a major contract with their very first silicon carbide customer in Taiwan, and Erickson explicitly noted that they beat out Semi-Nexus Test head-to-head for that contract based purely on technical superiority and industry reputation.
Okay, so the IP battle is definitely draining working capital, but they are scoring tangible wins both in the courtroom and in the actual marketplace. That brings us to the third and final risk factor, the sudden spike in operational expenses, or OPEX.
Yeah, operating expenses jumped significantly to $7.5 million in Q4. That's up from $5.4 million in the prior year.
Where is that extra $2 million a quarter going? Are they just getting bloated, or is it actually strategic spending?
It's strategic, but, it's still money out the door. The spike was driven primarily by 2 factors. First, they aggressively added headcount in their research and development department.
Which makes sense.
Right. When you have top-tier customers asking you to rapidly evaluate new AI device configurations on accelerated timelines, you need the engineering manpower to custom design those WaferPak contactors. You can't skimp on R&D. Second, the OPEX spiked because of commission payouts. Oh, right. If your sales team brings in a historic 500% spike in bookings, you have to pay the pipers. The commission checks are going to be massive. So it's a good problem to have, but it still impacts short-term profitability on the ledger.
Exactly. So we weigh all of this together. We have the 40% supply chain markup on power supplies. We have the slow, really expensive grind of the China IP lawsuit. And we have rising R&D and commission expenses.
Right.
But we have to weigh those risks against the 200% revenue growth guide, the $100 million in locked backlog, and the massive technological moat of wafer-level burn-in the AI space. It is time for the final verdict.
We are taking a firm, actionable position here based on everything contained in this earnings transcript. And the verdict is that this represents a highly, highly bullish signal for the stock.
Unquestionably. If you strip away all the noise, what you have here is a textbook infrastructure play. I completely agree. For you, the retail investor listening right now, AEHR is the ultimate picks and shovels play for the artificial intelligence gold rush. Think about the broader market right now. Everyone is trying to guess which AI software startup is going to be the next Google.
It's a guessing game.
It is. Everyone is debating whether NVIDIA can maintain its absolute monopoly on the hardware or if AMD will steal market share. But here's the thing. Aehr Test Systems does not care who wins the AI software race. They don't even care which hardware designer wins the chip race.
Not at all.
As long as the global race for AI dominance is happening, hyperscale data centers need millions of physical chips.
And the physical reality of those chips is that they are getting exponentially hotter, exponentially more expensive, and exponentially more complex to package. During the call, Erickson introduced a new, enhanced Sonoma high-power configuration.
Oh, this part was crazy.
He casually mentioned that this new system is capable of managing up to 2,000 watts of thermal dissipation per device for these next-generation AI GPUs.
We need to pause on that number, because 2,000 watts per single device is absolute insanity.
It's thermal violence, honestly.
It is. To visualize 2,000 watts, imagine taking a high-end commercial space heater, the kind that warms up a massive two-car garage, and focusing all of that blistering heat onto a single piece of delicate silicon the size of a postage stamp.
It's just hard to even fathom.
That is the thermal reality of the chips that are going to power AI next year.
And at those apocalyptic thermal levels, the physical necessity of Aehr's thermal testing and wafer-level burn-in becomes absolutely non-negotiable. You cannot skip this step.
You just can't.
If a hyperscaler like Google or Meta deploys a faulty, untested 2,000-watt chip into a live data center, and that chip suffers an infantile failure, it doesn't just quietly turn off. It can literally melt down the surrounding architecture. It can cause a massive thermal event that takes down an entire server rack worth millions of dollars.
The hyperscalers cannot afford that downtime. And they certainly cannot afford that hardware loss. So if you believe that the multi-trillion-dollar AI data center build-out is a real multi-year secular trend and not just a passing fad, then AEHR deserves very strong consideration.
Absolutely.
If you currently hold it, the thesis is completely intact to continue holding. If you are on the sidelines looking at the macroeconomic volatility, any broader market pullback or dip in this stock looks like a very compelling entry point. They are providing the essential, non-negotiable safety net for what is probably the most expensive technology transition in human history.
And they've engineered the business to do it safely. They are scaling with a capital-light outsourced manufacturing model backed by a massive cash war chest that protects them from getting overextended when the inevitable cyclicality of the hardware market returns years from now.
It is a total masterclass in corporate pivoting. Well, that brings us to the end of our core analysis. I want to thank you, the listener, for spending this time with us on this Talk Tickers deep dive. Our goal is always to respect your time, to cut through the jargon, and to give you the ultimate informational edge in your investing journey.
But before we officially sign off, we have one final tradition.
We do. We cannot let you go without pulling on one final thread.
Yes. We always want to leave you with a provocative thought, something hidden in the margins of the transcript to mull over and research on your own. Notice how we spent almost this entire deep dive talking about AI compute processors and silicon photonics networking.
Because that is what management said drove over 90% of their current revenue. It's the core story.
It is the story for 2026 and 2027. But if you dig deep into the Q&A portion of the transcript, hidden beneath all the headline numbers, there's a fascinating ongoing dialogue that management is quietly having with 4 of the world's top semiconductor memory suppliers.
Really? Memory suppliers?
Yeah. They are actively evaluating development agreements for testing high bandwidth memory, or HBM, as well as NAND flash storage.
Wait, high bandwidth memory is the massive bottleneck for all AI processing right now. We talked about heterogeneous integration earlier. The massive arrays of memory chips have to be stacked physically right next to the compute chips just to feed data to the AI model fast enough.
Exactly. The HBM market is exploding just as fast as the GPU market.
Right.
And here is the absolute kicker. None, absolutely zero, of this potential memory testing revenue is included in that massive $130 to $150 million guidance they just issued for 2027.
You're kidding. None of it.
None of it. That guidance is purely compute and photonics. The memory market represents an entirely separate, massive, total addressable market just sitting on the sidelines.
Why aren't they modeling it in? What's the catalyst that actually unlocks it?
It comes down to a fundamental shift in chip architecture. Erickson noted during the Q&A that new upcoming industry standards for high bandwidth memory are increasingly being designed with embedded bias capabilities.
Let's unpack that acronym for a second because it's crucial. BIAST, built-in self-test.
Exactly.
Normally, a testing machine, like the massive legacy machines from Aehr's competitors, has to send incredibly complex electrical signals into a memory chip and then wait for the chip to send an answer back to see if it works.
Right.
It requires massive, expensive computational power from the testing machine itself.
Right.
But BIAST means the memory chip has its own tiny diagnostic doctor built right into its own internal circuitry. The chip tests itself.
Precisely. The chip generates its own test patterns internally. All the external testing machine needs to do is provide a stable flow of power, apply the extreme heat or cold to stress the physical materials, and wait for the chip's internal doctor to send a simple pass or fail signal.
Oh, wow. If the memory industry shifts heavily toward biased architecture, those massive, expensive, traditional memory testing machines become incredibly overpowered paperweights. You don't need a supercomputer to test the chip if the chip tests itself.
You don't.
You just need a highly reliable, massive-scale thermal oven that can power thousands of chips at once.
Which is exactly what Aehr's FOX wafer-level burn-in systems are perfectly designed to do. This architectural shift in how memory tests itself could heavily favor Aehr's massive parallel testing architecture over the slow, legacy memory testers.
So here is the question we leave you with to research on your own. If Aehr Test Systems can successfully adapt their FOX systems and proprietary contactors to capture the high bandwidth memory market, could memory testing become their next 500% growth driver by 2028?
It is the ultimate wild card. If they land just one development agreement with one of those 4 major memory suppliers they are talking to, their total addressable market expands exponentially all over again. They wouldn't just be the toll booth for the AI compute chips, they would be the toll booth for the massive memory arrays that feed them.
And it brings us right back to the incredible narrative of where we started. 2 years ago, if you looked at the surface of this company, you saw a business tied exclusively to electric vehicle inverters, essentially building X-ray machines to sort the good car engines from the bad.
It looked like a clean, binary, completely limited market.
But beneath the surface, the engineering team was quietly building and patenting the fundamental diagnostic tools for a vastly more complex, incredibly lucrative landscape. They didn't just fix the X-ray machine, they adapted it for the artificial intelligence revolution.
And the trajectory they have plotted based on this Q4 transcript is pointing straight up.
It's an incredible story of survival and reinvention. Keep digging into the numbers, keep reading the transcripts, and above all, stay curious. We will catch you on the next deep dive.